Good afternoon, everyone. Or should I say good morning, good afternoon, good evening, because we have so many people on this Telegram channel from different parts of the world. So I won't just specialize in just greeting one particular type of or one particular region of people rather. Okay, so welcome to today's bootcamp. So we're supposed to have the bootcamp on Thursday, but a lot of people said today was going to be a very decent day for them to be able to attend the bootcamp so that they can always interact in the bootcamp. So we have it here today. So it's great to have you guys here. So without wasting much of your time, let's get to what we have for today's bootcamp. And for today's bootcamp, the theme of today's bootcamp is how to diversify your portfolio in Nigeria. Okay, so most people don't even know how to go about diversifying their portfolio in Nigeria, but if you stick to the end of this bootcamp, then you should be able to understand how to go about it the proper way so that you don't get things complicated. Now, what we want to do is a very clean finance checklist. We don't want to complicate things. We want to make sure that we are doing something that actually favors most people that are ready to actually invest in the Nigerian market. Now, I remain your host, Temi God, as you already know, financial strategist and a mentor. Okay, so let's just go straight to what we have to do for today. So I'll be sharing my screen with you guys. Okay. All right, so we have that right now. So I'll be heading over to what we have to do for today. So I said how to diversify your investment portfolio in Nigeria. So we're going to be having a smart way of diversifying our finances today. Okay, so this will help us reduce risks, have balanced return, and grow our wealth perfectly in Naira. Remember, I always tell people that Nigeria is one of the best place, or Nigeria actually offers the best value for money. Okay, I'm not trying to say that the US market is not good or other markets are not good, but if you are looking at putting a foreign currency into any investment vehicle, then you should opt out for Nigeria. Okay, our Treasury bills will actually offer you more interest than that of the US. Our bonds will offer you more interest than that of US. I think the US actually offers like 4 or 3 thereabout per annum, or up to 5 in most cases, but then Nigeria offers up to 16%. Okay, so imagine you convert your dollars into Naira, you do it and you convert it back. Irrespective of the interest rate that is not stable, you are still going to make money, however. Okay, and you are still going to make more money investing or putting your money in Nigerian market rather than any other market. And that is why we came out as the best, or one of the best performing stocks for 2026, and congratulations to us. So we just improved ourselves a little, and I like the way most people are paying attention to the Nigerian market, especially Nigerians. I like the way we are paying attention to the Nigerian market. It shows that we are ready to take our finances from one step to another, and we are no longer the country that depends on the government to do everything. Okay, remember, a nation is not only built by the government, but at least by the people as well. But the government is going to make an enabling environment for a great nation to be built. Okay, now without wasting much of your time, let's just go straight to what we have for today. Now, these are the things we are going to be covering up for today. We are going to be checking, or we are going to understand what diversification is. We are going to understand the 60-40 framework. We are going to know how to diversify fixed income and how to diversify equity. You know, most people, when they hear diversification between the fixed income and the equity income, most of them think you're going to just put it in one place for fixed income, put it in one place for equity, but that is not how it goes. Okay, so we're going to take an example of what we call the 5 million portfolio structure, and you know, when and why we need to rebalance. Okay, so that's what we are going to be doing for today. It's just 6 topics and it's going to be interesting. So stick to the end of this video and you're going to learn a lot from this video. Now let's start with what is portfolio diversification? Now, portfolio diversification means spreading your money across different investments instead of putting it in one place. Remember, there is a saying that do not put all your eggs in one basket. However, you should put it in different baskets. Because if you happen to break one basket, you know that you still have more eggs to keep running. You remember the world runs on money. So you don't want to be that person that actually keeps your money in one place, and if anything happens to go wrong in that place, you now lose all your money. So you want to spread all your money, or you want to spread your money across different investment portfolio. However, you want to keep it safe while earning high. I hope you get that. Okay, so why does this matter now? Because different investment behave different under different market conditions. Now that's what you need to know. Different investment actually behave different under different market conditions. Now, what does this say? Now, in the stock market, when interest rate is being, or when the government actually rises the interest rate, more people will want to invest in fixed income. Now, that would actually make the stock market to depreciate in price, because most people want to shift their money from an equity market into the fixed market. Okay, and so the market is going to change its behavior. Okay, so you can now, like I said, stock can fall during market downtime. And I just give an example of what can actually make the stock market actually fall in real time. Now, treasury bills may continue or may generate more money according to the term. Okay, now sometimes the reason why stock fall is because investors see more opportunity in things like treasury bills, commercial paper. Like I said earlier, the interest rate has been risen up, and most people want to take their profit out of the stock market and actually invest in something that is a bit safe and has minimal risk. Okay, now money market provide exposure to short-term instruments. Okay, now what is money market? Money market is actually a diversified portfolio as well. So money market can carry things like treasury bills, commercial paper, and some can even carry stock, especially the equity money, especially the equity market fund. Okay, so the money market is actually different from the equity market, but all of them fall under the category of mutual fund. And mutual fund has three categories. Okay, so we have the money market, which you can see here. We have the balanced portfolio, and we now have the equity portfolio. Okay, so now bonds can provide long-term fixed income exposure. You know how bonds work. Now, bonds is like fixing your money for a particular duration of time, while you collect your interest upfront every year, depending on how the bond, with the agreement of the bond. Okay, so that's how bond works. Now, this might provide fixed income for certain investors, and certain investors like investing in the bond. Okay, different sector can actually perform differently. Okay, so the goal isn't to find an investment with zero risk. Such an investment doesn't even exist. Okay, no investment that comes with zero risk. Even the ones that are fixed income, you can have the interest rate go up and down, which will actually affect your returns. Okay, so you can go into something like money markets. When you went into that money market, they were having a return of 18 or 20%, but over the long term, you can see that the things are fluctuating, and you can see 16, 15, and this thing is actually risk. Now, for someone that has already positioned themselves that this is what they want to get, that movement, that increase and decrease in the interest rate might actually affect their returns and affect the way they want to get their money. Okay, so the goal is to avoid having one investment determine the fate of your. The goal is to avoid having one investment to determine the fate of your entire portfolio. Now, what you want to do is that you don't want to have one investment that will determine the fate of your portfolio, but rather you want to spread your money across different investments. Okay, now think of your portfolio like this. Okay, instead of what should I invest, start with what job should each part of my money perform. Okay, so you want to know if your money should be in the fixed income or the equity income or both. But I actually recommend both, and let me tell you why I recommend both. Now, the fixed income will give you what? Stability. Now, most fixed income, your capital is not at risk. It is only your interest that is at risk. And now, how is your interest at risk? Means your interest might not be stable. Means if you are someone that is expecting 18% interest every day, you might have ups and downs in this thing, in some kind of investment. Okay, and some kind of investment might default the interest. Okay, but then in most cases your capital will be safe. However, equity has a risk on your capital and whatever you gain on. Okay, but however, equity grows faster than fixed income. Okay, so you want to have balance, then you want to have growth. However, you want to do these things in a way that brings balance to you. So when some people hear balance, they think you want to put 50% here and put 50% here, but that is not always the case. Okay, because you want to do it doesn't mean that you should put 50% in fixed income and put 50% in equity. Now, that balance is how you spread your money, which we are going to talk or discuss in this bootcamp. Okay, now different investment don't just have to compete with one another. They have to do what? Different job. Like I told you, I said your fixed income will help you what? Have stability, while your equity will do what? Appreciate your capital. Okay, so one is helping the other. Okay, and the end result we want to see is both of them coming out in flying colors. Okay, now let's go to the 60-40 portfolio framework. Now, what is the 60-40 portfolio framework? Now, I drafted out this framework to help people have a balanced portfolio. Okay, instead of you to rack your head or have this panic, or have this hard time in how to spread your money, why not use this strategy I'm doing? Okay, now I said the 60% goes for the fixed income, providing you with stability. Okay, so you can invest it in treasury bills, money market, commercial paper, bonds, and fixed income, while the 40% goes to equity. Okay, exposing you to long-term growth. Now, for some people, it works different. Some people, I might tell you to do 70-30. That is 70% fixed income and 30% equity. The main thing is that your equity, which guarantees you safety, needs to be higher than your fixed income, which guarantees you safety, needs to be higher than your equity. And that is just the major context of everything, so that you can have more protection, then you have less money fighting for growth. Because the truth is that, let's take an example quickly. Okay, let's say you are someone that had 1 million naira and you want to use this 60-40. Now, let's say you invested or you joined our community and you took some of our trades. According to the trades I actually dropped in the community for free, my portfolio is performing something around 60% increase. Okay, so let's take 60-40. Now, you invested in a fixed income, and let's say the total interest for that income is what? The total interest for that income is, let's say, 16%. Remember, it's small. 16% is small. Remember, our equity did 60%. Now you invested 1 million. Okay, let's say 1 year, 1 million. You divide it. You remove 400k for equity. You are left with 600k for fixed income. Now let's say 16% of that 600 would give you 96,000. So if you plus it plus 600, you'll be having a total of 696. Okay, that is cool. Nice. Now with this 60% profit and loss on our equity, so 60% of 400 would give you 240. Look at it, more than half of the money. Now plus your 400 will give you what? 640. Now, if we plus it with the initial 696 we have here for the fixed income 696, we have a total of 1.36 on 1.33600. Okay, 1,336,000 naira. Okay, so that's what we have total. Now, which brings us to what? A total increase of 33% from the total or the overall capital we actually invested in the business. Remember, we invested 1 million, and this is what we have for the whole year. Now, you might want to say, if I had put the money in the equity market, I would have made purely 60%, which amounts to what? 600,000. However, what if it doesn't go your way? What will be your protection? Okay, what about if you lose? Let's say if the equity market or whatever stock you bought or whatever equity you invested in is having a total portfolio of 20% down, means you'll be losing 20% of the 1 million, which will keep your money at 800,000. Okay, it will keep your money at 800,000, which doesn't make sense. Okay, now, but then again, let's say that thing happens, and that thing happens in your 400. Okay, so that is 200. 20 times divided by 400. Okay, 20%, that would be just 80k minus minus 400. So you'll be left with 320. Now, if you take that 320 and add to the 96,000 you fixed, okay, that gave you that fixed income, that will give you plus what? 696. Okay, that will be amounting to what? 1,016,000 naira. Now, overall, you are still on profit of what? 16,000 naira. At least it is 1%. It is better than losing all your money. Now, you see the power of diversification. You can see that one is helping the other. Okay, now let's now assume that you took all your money to the equity, to the fixed income. Okay, that will be giving you just what? At 16% will give you just what? 160. It is fair. However, you missed an opportunity of increasing your portfolio to a total of what? This. Okay, so if you remove that 160 from this, you actually missed 176,000 naira because you did not diversify properly. Okay, now remember, the goal is not what? It's not that this is better than this. It is just a mixture of this and this, which would have given you what? Which would have given you this this as your what? Total money, instead of any other thing. You can see that this is far away the best after we have concluded everything we're saying. Now, that is how this thing actually works. Okay, now look at the 1 million that I just explained right now. You can see what I said, and I explained how it's gonna work, and we are done with that. Now, but 60-40, but is 60-40 actually right for everyone? Like I said, these things doesn't work for everyone. Some people might need to invest more on low risk, okay, and different things that, or one of the factors that will make people want to live life that way is what? Age. Okay, now I said two investors can have the same amount of money but completely different portfolio structure. I said investor A young investor, long investor, horizon, stable income, high risk tolerance. You know, when you are young, you can take more risk. If you are single, you don't have too much Nigeria will say bugata. You don't have too much bugata to face. So that might plug you to want to take what? More risk. Now, this person might have higher allocation. Now, this person might want to go with the 60-40. It might be stable for that person. Now, investor B needs more money too soon. You understand? Like I said, he has more bugata to face. Maybe he has children in university. This. Now, that person might want to do 70-30. Might even want to do 80-20. Because that person now will be looking at, okay, if this one doesn't work out well, the way I plan, at least this money here, I can use it to solve these children's school fees, solve food, solve this one, solve that one. So it doesn't work for everyone. However, If this person, if investor B has more money, he can still use that strategy of investor A. The major thing is having more money, less expenses, more income coming. If your income can outweigh your expenses, then you are good to go. That is it. Then you are good to go. Means this is right for everyone. This is right for most people. If your expenses can be below, below your income, means you have more income, less expense. This can work for you. Means you can do more risk. Now, why did I say age at first time? Because most aged people have more expenses. You understand? They have more expenses. Why most young people, like I always say, if you cannot put your life together when you are young, it becomes very difficult for you when you start giving birth. Okay, when you have more things to pay. Okay, it becomes difficult for you to save. It becomes difficult for you to do this. I always tell somebody that, okay, see, do you know, as a Nigeria, you can survive by making 4,000 every day. Now, this thing I'm saying is not for someone that has too many expenses or that is a family person. This strategy is not compatible for them. It's compatible for somebody that is single, somebody that can manage gala and cook, somebody that can even eat 1 square meal. You understand? Somebody that can eat bread and akara. That thing is compatible for them. Now, this thing might not be compatible for someone that is married, because only the person can say, okay, do you know what? I can save 1K, I can save 2K, depending on the individual. It's just reality. I can save 1K, I can save 2K, especially if you make this money from somewhere that is not too far from your comfort. You can save 1K, you can save 2K. That is okay. But now, if you put the same strategy on someone that is married, it might not work. That's why you might see some people earning even 300, 400, 500, but then they are finding it hard to keep money. Because I always say that finances is different for everybody. It's different for everybody. It just depends on what you are going through at that time. And you can see where this investor A and investor B comes in. It depends on what you are going through at that time. You might stay in Nigeria, you might think 1 million is enough until you have 1 million naira every month as salary. Then probably you have someone that is sick, you have this one to pay, you have one house rent, you have this one, you have so many children. Then this becomes difficult for you to fix. You understand? This becomes difficult for you to fix. So that's why I always tell people that finances is different for everyone. You understand? So it's different for everyone, like I said. And this illustration will make you understand that finances is actually different for everyone. Different people, different risk tolerance. You understand? So now, this is a practical structure of how you can put your 60% fixed income. You can either put it in treasury bills, money market, commercial paper, bonds, savings, and fixed deposit. But for me, I would advise you to take at least 3 out of it. And the best 3 is what? Treasury bills, money market, and fixed deposit. You can use bonds too as well. That is the closest. And the a bit risky one is commercial paper. Understand? So these are examples of fixed income that you can put your money in. Now, when we come to risk, we'll find out that treasury bills is one of the most safest. Okay, followed by the bond. Now, followed by savings and fixed deposit, followed by money market, then commercial paper. Now, why is money market and commercial paper? Why did I put them outside very well? Because one, your interest can drop on this. This commercial paper can default. Money market interest can drop, while commercial paper, the creditor can actually default. Okay, and it happens. Okay. Now, like I said, this is it. Okay, treasury bill, short-term government exposure, money market, diversified short-term instrument, commercial paper, corporate credit exposure. Now, the commercial paper and the treasury bills are most likely the same thing, but just that one is for the government, one is for corporate entities. Okay, commercial paper is for corporate entities, and treasury bills is for what? Government. Both of them are what? Short-term debts. Okay. Now bond is a longer one. Fixed deposit is a bit longer one. Okay, most fixed deposit want to do 1 year in most cases. 1 year, 6 months, some cases 9 months. It depends. But this is it. Okay, this is the framework. Now, this is your equity. In most cases, this is what it does for you. It helps you for long-term growth, capital appreciation, participating in business growth, and potential dividends. Okay. Now, you can see that the equity can actually produce something that looks like a stable income, but we can't really call the dividends a stable income because sometimes these things might default, just like commercial paper. It might default. Some cases, some companies might not pay dividends that year, okay, which might make them default. Okay. Now, what just matters is proper what? Equity diversification. Okay, spreading it across companies. Okay, with strong financial record. Okay, very good sectors, and diversifying it into other equity investment vehicles such as ETF. Okay, real estate trust and other sector funds. You understand that? Now, here are one of the best sectors you can diversify your for equity, your money for equity. Banking remains number one. Okay, next one is consumers good. What are consumers good? Something that me and you consume on a daily. Okay, example is like cushion. You understand? We consume Cadbury. All those things are consumers goods. Okay, industrial and cement, your Dangote, whatever, all these things. Then your energy company, very good. Energy, both gas, oil, all these things are energy. Your insurance company, another growing sector. However, these few past Q1 and Q2, they did not perform very well. But let's just see how it goes, okay? Then your ETFs, like your Stanbic ETF, so on and so forth, are very, very good sectors you can invest in. Make sure you are investing in sectors that you can actually resonate with, and that is the major things. That is the main purpose of investing. Okay, like I said, you don't need 50 stocks. You only need to avoid having one company or one sector that will determine the outcome of your portfolio. You don't need to buy all stock. Just have the ones that okay, like 10. I have 1 million. I'm going to spread 100K into 10 stocks that I'm sure of. Then find yourself around these sectors and invest. Okay. So, like we said, this is the 5 million portfolio. Okay, it's just the same thing like what I explained in the 1 million that I explained. I said, okay, if you want to diversify your fixed income, you can put more money in treasury bills, like I said. Okay, now you can go into money market, commercial paper, bonds, then fixed income this way. Okay, then your equity, you can put more in banking because banking is one of the fastest growing sector. Then consumer goods, you understand, is the next fastest growing sector. Cement, that is bio-cement, Dangote cement, very good sector. The oil and gas, very nice one. Then 4% in your insurance because it's just growing gradually. Then ETF 4% as well. So this allocation is how you are going to also diversify inside your fixed income and inside your equity income as well. So okay, so the final lesson for this is don't just invest, allocate. Okay, one of the biggest mistakes investors make is what stock should I buy before asking how do I structure my portfolio. That should be your first question. Your first job isn't to find the stock that will double your money. Your first job is to build a portfolio that matches your goal, your timeline, your risk tolerance. Okay, and when you combine different investment properly, each part of your portfolio has a specific job. Okay, now like I said, the fixed income stability, okay, helps you what? Protect your capital, provide regular income, reduce overall portfolio risks, act as a buffer during market downline. Now you need a buffer in life. That's why when you want to go for a contract or attend a contract, you need to add a buffer. So your fixed income is a buffer for your finances, while your equity drives long-term growth, builds wealth over time, helps you beat inflation. That is one of the sweetest things. Like I said investing in Nigerian market is one of the best way to beat inflation. And I've said it before. I think I wrote it on my threads. It's one of the best way to beat inflation. That's why I said, okay, so invest 60 in fixed income, invest 40 here. So that if this is going to grow, you know that whatever you get from equity will help you beat every other amount you get from fixed deposit. Why? It will just double your growth. Okay? So that is it. And what provide potential dividends for you. So the goal isn't to build a well-allocated portfolio that can grow your wealth. So the goal is to build a well-allocated portfolio that can grow your wealth while protecting you from unexpected things that can happen. Okay? So that'll be all for today's section. And we'll be having the Monday section by 10 again. So let's check out what will be the markets will be looking at for next week. Okay. So that'll be all for today's section. So see you guys in the next section. Bye for now.